Okay, let's get started, everyone. Thank you for joining this webinar. I'm very happy to be here and present this special webinar presenting QuantmRE, where we discuss how they'll be leveraging tokenization to help make home equity accessible, investable, and tradable. My name is Richard Johnson. I'm the founder and CEO of Texture Capital. We're a FINRA member, an SEC registered broker-dealer, licensed for digital asset securities, primary offerings, and we provide an alternative trading system for secondary trading. We help our clients compliantly issue tokens representing equity, debt, revenue share, royalties, and other types of investment contracts. Joining me today is Matthew Sullivan. He's the founder and CEO of QuantmRE. He brings to us 25 years experience in technology and finance. He's a serial entrepreneur and internet pioneer, having previously worked at Richard Branson's Virgin Group, where he's been appointed director and trustee of the Virgin London Air Ambulance. So I know who to call next time I get attacked.
That's right.
Also here is Mark Rogers, head of origination for QuantmRE, 30 years experience in financial management and operations, co-founded a venture company with the former chairman of Novell, and holds Series 724, 63, and other securities licenses. And last but not least, Steve Hodovec, business development, strategy and channel sales, 25 years experience in brokerage, trading, and alternative investments. Also a FINRA registrant, 724, and other licenses. But he trumps the other 2 years. Also has 2 patents. So there we go. Looking forward to a great panel today. Before we get started, I am going to have to kind of read up a few little disclosures here. Whilst this webinar is not a solicitation to buy or sell securities, participants should be aware that the private securities offerings are not registered with the SEC and are considered highly speculative, involve a high degree of risk, and may result in the loss of your entire capital contribution. Blockchain is a new technology and unproven in financial markets. There's no guarantee that tokenization will enable any secondary market liquidity in the future, and your investment may remain illiquid. Potential investors are advised to consult their tax, legal, and financial advisors before investing. Okay, so without further ado, let's get this thing started. And I'm going to hand over to Matthew Sullivan to tell us how he's going to be leveraging tokenization to make home equity investable, tradable, and accessible.
Richard, thank you very much, and welcome everyone. Delighted to have the opportunity to tell you more about QuantmRE. So let's start with these 2 key problems that we're solving. If you're a homeowner and you want to access some of the equity that's locked up in your home, your options currently are very limited. You can either take on more debt through a cash out refinance, a reverse mortgage, a HELOC, or you can sell the property. So in other words, if you want to tap into some of the equity in your home, you've got to either sell the house or go deeper into debt. So that didn't sound like a very good set of options for us. The second problem relates to investors and access to an asset class that is measured in trillions of dollars. Now, residential real estate is the largest asset class in the world. It's a major driver of the economy and personal wealth. But most of this wealth is owned by households and is not investable. At the moment, it's very difficult to invest in the equity in owner-occupied homes. We're not talking about investing in properties that you buy and rent out. We're talking about investing in properties that are not for sale. The scale of residential real estate equity, and it hit a record $29 trillion this year. And I think we've all really seen the price of our houses rocket up. And I think now over half of the residential properties in the US have more than 50% of the value of their homes in equity. So in other words, nearly half the homes in the US, the owners are what you would describe as equity rich. But the biggest problem, you remember what we said earlier, if you want to get access to your equity, you've either got to sell or borrow money. The reality is that trying to get a mortgage, it's never been more difficult, it seems. trying to get cash out refinances or HELOCs. And if you look at that graph in terms of mortgage credit availability, it's fallen off the edge of a cliff. So you've got these sort of two opposing forces, huge amounts of equity in the property, and very, very difficult to get your hands on it.
Matthew, how do you think what about the current market environment? I'm sure a lot of people are thinking about that. You know, we have rising interest rates, rising inflation. How do you think that's going to affect the market for this home equity asset class?
Well, I think let's answer that by describing what the solution is to these two key problems. So remember, the two key problems, first of all, as a homeowner, how do you get access to your equity? As an investor, how do you participate in the equity in homes that are not for sale? So if we go on to the next slide, and then Richard, hopefully we can answer your question with that. So the next slide describes what the solution is. And the solution is a structure which is known as a home equity investment. And a home equity investment is something that most people have not come across. It is not an asset class that is commonly used by real estate investors, even though it's been around for over a decade. And a home equity investment is a structure that is very similar to an option that enables the homeowner to get liquidity in exchange for the investor getting the right to a share of the future value of the home. So the trade is, in exchange for a share of the value of the home, I, as an investor, give you, the homeowner, that much needed liquidity. But the really important thing about home equity investments is that they are unlike most other real estate investments, because of the way that they're structured enables the investor to buy into residential real estate from day one at a 40% plus discount to the current market value. So what that means is that you're buying into residential real estate at a huge discount to the current value. So to answer your question, Richard, if we think, like many commentators think, that residential real estate is unlikely to see significant growth in the near term, the home equity investment structure is ideal, because that 40% plus discount builds in downside protection for the investors. And what that means is that the underlying real estate can stay flat or can actually go down in value, but the home equity investment structure can still deliver positive returns. So let's go on to the next slide and go through an example about how this works.
Even, you know, my thoughts were, with interest rates going up, the cost of a HELOC is much higher at this point as well. So that could be another better solution, because with a HELOC, you've got to pay interest payments and so forth.
It is exactly that. But the biggest problem with interest rates is that you've got this sort of the immovable force hits the, so the immovable object is sort of hits the irresistible force, where you've got people needing to get access to home equity, but they now find themselves in a position where they don't want to take on a HELOC because of the uncertainty about interest rates, or they simply just don't qualify. Well, so you've got there is that element.
The issue is, for pretty much the last 40 years, people have been able to do cash out refis, where they took additional cash out and their monthly payment went down. Here, where in the last year interest rates have doubled, a cash out refi becomes unaffordable, because on that mortgage that they're refinancing, their interest rate's going to double along with an additional amount, so their payment would go up exponentially.
And that's a real problem for many people. And again, it's solving a problem where we're saying, how do we get access as a homeowner to this equity? How, as an investor, do I participate in the upside potential of residential homes that are not for sale? So here's an example where we have a property that's worth $1 million, and the homeowner wants $100,000 of liquidity. So this represents 10% of the current value of the property. We move on to the next slide. In exchange for providing that $100,000 liquidity, the investor signs an agreement, a home equity investment agreement with the homeowner, which states that in exchange for providing you with liquidity that equals 10% of the current value of the property, you as the homeowner agree that when you settle this agreement, which can be any time in the next 10 years, or if you decide to pay it off early, you'll pay us the equivalent of 17% of the value of your property at that time. So what that means is that as an investor, I'm buying $170,000 worth of value in your home for $100,000. And so that's how we get that 40% discount. I'm buying a discounted percentage of the value of your home. And most importantly, this agreement is backed up by a lien on your property. So it's recorded as a trust deed. So I can enforce this agreement. So what that means in depreciating markets, which if we go on to the next slide, let's say that the value of this property goes down in value by 5% a year over the next 4 years. And I think that's way in excess of what anyone really believes property will do. And historically, property hasn't performed as badly as that over a 4-year period. But the value of the house is now down to $814,500. So 17%, remember, of the value of the property is $138,446. So that's still $38,446 more than we invested, even though the value of the property has fallen by almost 20%. Now, if we go on to the next slide and say, well, what happens if the house doesn't go up in value? So 4 years later, the house is sold for $1 million, or the homeowner decides to buy us out. We will get $170,000, 17% of the value of the property. So that's giving us a low teens IRR, even though the underlying property value hasn't gone up. So what happens if property actually goes up? So if you go on to the next slide and we take a very conservative view and say that property goes up by 3% per annum over the next 4 years. So the performance of the home equity investment gives us as the investor 16+% IRR. So the structure of the home equity investment is incredibly useful to investors because, remember, it gives you access to a very important untapped asset class, which is the equity in single-family homes, equity in homes that is not for sale. And at the same time, it delivers that downside protection. But the way that the contract is structured, if the property goes up in value, you get an enhanced or an accelerated return.
So there's
and I think really that's
question here. Does the homeowner have to stay in the home for the 10 years?
The answer is no.
Okay.
And so it's not like a reverse mortgage. So I think there's a whole other webinar we can go through as to why these are so much more flexible for homeowners than many other traditional debt products.
Yeah. The homeowner has the ability to buy it out at any time. So after 1 year, the homeowner could buy it out. And if the house hasn't gone up in value, you would see the return.
Mm-hmm.
So we understand, coming back to the home equity investment structure, this has been around for over a decade. In the last 7 years or so, there's been a significant increase in the amount of activity. And we believe that at least $1 billion a year is now being written by companies that offer home equity investments. Most importantly, in the last year, we've seen 4 securitizations. So we've seen home equity investments be originated, be invested by typically family offices, endowment funds, and hedge funds. And we've seen a secondary market develop, which is great. So as investors, we say, how do I get hold of this? And therein lies the problem. If you want to invest in home equity investments, there are a very, very limited number of companies that provide origination services. And they already have a long line of investors that want to buy contracts that they originate. So one of the major problems that we solve for investors with tokenization, with our market and trading platform in conjunction with Texture, is that we create access to these investments for smaller investors. And smaller investors means accredited investors, hedge funds, smaller family offices, investors that want exposure to residential real estate through the home equity investment structure, but don't want to commit to expensive securitizations, don't want to have to go through the process of forward flow agreements and other restrictive type agreements with the existing originators. So we're bringing marketplace dynamics to what we believe will be one of the most interesting asset classes that we've seen in a number of years.
So yeah, I mean, what I think is very transformational about what you're doing is you mentioned that these home equity investments have been around for 10 years or so. Who are the participants in that market now? It's the big players like Blackstone or BlackRock, I forget which one, but putting in hundreds of millions of dollars, and you know, these large institutional investors. And what you're doing and what we're working with you to do is to kind of tokenize these securities, fractionalize them, and then make them available to retail investors for the first time. Right. So it's really opening up and democratizing this market using tokenization.
Right, Richard. If you look at maybe the market traction in this space, especially over the last 7 years, you have a large and growing demand from both homeowners and institutional investors. Mm-hmm. Collectively, the new HEIs in the last 7 years estimated at about $1 to $1.5 billion annually, and as Matthew mentioned, the securitizations have been about $920 million. The problem with all of that, or the challenge, is that unless you have hundreds of millions, that opportunity for you to invest and receive the economic benefits that this structure provides sort of shut off. So this is the equivalent of bringing to the HEI space what real estate crowdfunding has done to the real estate space.
And that's absolutely right. It's all about bringing marketplace dynamics to an asset class that is measured in trillions, but is still locked up and only available to a few institutional investors, which is exactly the same story that we had, you know, when real estate crowdfunding platforms first launched. And now they measure their assets under management or the asset throughput in billions of dollars, because the success that we've seen with real estate crowdfunding has far exceeded most people's expectations. So we're using the same methodology, but enhanced methodology because of the technological impact and the technological advances that blockchain technology brings to us. We're bringing that same crowdfunding dynamic and opening up an asset class, which means that we give access to investors, but most importantly, we give investors the ability to trade. So in other words, real estate crowdfunding platforms on the whole enable you to buy in the primary market, and then you hold and wait for something to happen to your investment, which means it's in control of the sponsor. There are very few platforms that provide that two-way trading. So one of the most important differences, apart from being the only platform that we're aware of that gives investors access to this hugely important asset class, the home equity investment, we also, working with Texture, provide you with the ability, or will provide you with the ability early next year, to be able to build, model, manage, and trade portfolios. And that's very important because as an investor, you can buy a fraction of a home equity investment, you can buy pools of home equity investments, or you can buy specific targeted investments, which means you can build your own portfolio based on your own requirements, as opposed to relying on, you know, managers or other sponsors.
Can you talk a bit about why you chose to tokenize and how you use the technology?
The most important thing to mention here is that this is not a cryptocurrency play. And I think we've seen a lot of contamination from FTX and other marketplaces. So it's really important that we differentiate what we're doing to what has happened in the marketplace. Cryptocurrencies use the same fundamental technology that we do. So the technology is the same, but our application and use is very different. So we use the same technologies that provide that speed of execution, that reliability, the ability to prevent double spend in a very light manner, the ability to prove trades have happened, the ability to settle a trade almost instantly. Those are all the great things that blockchain as a distributed ledger technology provides. So we use that, and it's a very effective way of making sure that we have an immutable or an unchangeable record of who owns those fractions. So if we're going to take an asset like a home equity investment and chop it up into lots of pieces, enable those pieces, those atoms of a home equity investment to trade, blockchain technologies provides an excellent, cost-effective and reliable technological solution to enable us to do that. So it is ideally suited to this type of application.
Great. You're obviously preaching to the choir with me here, but it's great to kind of hear your perspective. And I'm also, just want to say very happy to be working with you guys, because I think it's a really, really powerful use case of how we can use this technology to kind of improve market structures.
And again, the important thing, if we can just pop on to the next slide, is that this has been built. It is operational. We have traded. So this is not something that we're going to do. We're working with Texture to bring in a very important layer, which requires a regulatory sign-off. So in other words, we require SEC regulatory infrastructure to be able to trade these tokens or to be able to trade these assets. And that's an incredibly important part that Texture provides. And Texture is one of less than a handful of companies in the US that can provide that. But you can today go onto our platform. We, as a management team, have invested over $1 million of our own capital into funding the first few home equity investments. And so we primed the pump with high quality investments that we've originated. So you can today go in and buy fractions of these investments, and early next year, or towards the end of first quarter next year, we expect that you will be able to buy and then immediately trade. So the important thing is the platform's been built. It's going through a continual process of improvement, but it is here today, and it is functional. And we're able to demonstrate how this works. Yeah,
what I think is very, definitely if you're interested, please reach out. We can schedule a follow-up meeting and a demo with the team here. But I think what's very powerful to me when I saw the demo of the platform is that you can kind of really zoom in by zip code or by street. So if you have a view on your neighborhood, or you think that there's a Whole Foods opening up and that's going to increase property values, you can target that area very specifically. You're not just going into a blind pool here. And I think, obviously, real estate is something everyone understands as well.
Yeah, and again, the power of that, again, let's remind everyone what you're buying. You're not buying a property. You're buying the rights to the appreciation. You're buying the rights to the future value of a home that is owner-occupied. It's owned and occupied by someone that cuts the grass, fixes the roof, paints the exterior, looks after their property, most importantly, pays the mortgage, pays the taxes, pays the HOA fees. You don't have that same management overhead of owning property. And that's why we believe this is a much better asset class than simply buying assets that then have to be managed and maintained. The old toilets, tenants, and trash scenario is there for a reason. What you're able to do is buy into these properties at a very granular level. So you can buy parts of a home equity investment in a certain area, parts of a home equity investment in another area. You can build a portfolio of fractions of these home equity investments. So you can build a portfolio that covers a wide geographical area without having to put a large investment in. And that's why this is so suitable to smaller investors who want to get involved in real estate investment, but don't have those deep pockets that institutions have.
Yeah, and you can buy it on the secondary market or the primary market. So I think you create, the value isn't just realized at when the homeowner sells the house. If somebody sells on the secondary market, there's a valuation going in anyway, and it's being appraised at what. So they're capturing what the appraisal has been since they purchased it. Is that correct?
It is, exactly. And again, that's a very important point. As you hold these home equity investments, as the property continues to appreciate, or if it stays flat, or even if it depreciates, you're still accruing value through simply holding the asset. And obviously, there are a number of sort of disclosures that need to go with that. But the important thing is you don't make your money just by buying and selling it. There is embedded value that continues to appreciate or continues to accrue just because you're holding that. And that's because the homeowner is obligated to you to provide you with value based on the future value of the home. And that embedded discount continues to deliver value while you hold the asset. Steve, if you've got a moment, I mean, it would just be great to hear about yours and Mark's experience in this particular asset class, which I think has consumed us for a number of years.
Yeah, maybe in a nutshell, having been involved in this asset class for 8 years, what has always been lacking is a platform that started out with the end in mind. And the end in mind is that third leg of the stool of you have accessibility by the homeowners and a lot of education. Then you needed education for the investors. So that's accessible and investable. Version 2.0 of home equity investments, we've now seen as tradable, but they've only been tradable at the institutional level. So this is a product where both the investor and the homeowner sides are acutely aware. And you sort of had this, you have had a perfect storm of between COVID and what I never thought would happen, which is the just massive infusion and appreciation. Homeowners are sitting on more wealth, and more household wealth is concentrated in home equity than ever before. And as you showed in the earlier slide, the spigot for traditional sources of liquidity, which is really only two options: either borrow more money, where homeowners are either unable or unwilling, or sell the entire asset. And so just as the stock market looks 6 months, a year in advance, the premiums that the investors are getting right now for providing liquidity are probably the best that they're ever going to be. So the timing of this is, it's a little bit of an education curve, but this is an asset class whose time has come. And I think the awareness and the legal, the regulatory, and the infrastructure over the past 4 years or 3 years has completely evolved. Yes. So you're going to hear more and more about this from numerous sources.
Yep. So how do people get involved then?
And again, there's a number of ways, and I think really just echoing what Steve's saying, because we're not at the beginning, which is a good thing. There's been an enormous amount of work, time, money, not just us, but the whole industry. So it's evolving quickly. So we have a fund that enables you to invest directly into home equity investments that we then post onto our secondary market platform. So the purpose of that fund acts like a wholesale fund, enables you to invest in hand-picked home equity investments, and then potentially gain additional economics if we're able to market and sell those home equity investments on our secondary market. So the important thing about the fund is that the investments themselves have that same strength that we talked about earlier in terms of the downside protection. But also, if we're able to sell them, that premium enables the fund to generate additional returns. It's a $10 million fund. We've already pre-funded it with just under $1 million of our own assets. And we expect that we'll see some momentum very, very soon. The second way of getting involved is to buy into us as a company. So we're working with Richard and his team at Texture to go out to the markets for a Series A round. So we've raised about $2.5 million over the course of the last 4 years. We've used the money carefully, and we've delivered a platform and a business that we said we would deliver. So we've made good use of that capital, and we're now in a position to grow and to expand quickly. And the third way really is just to go onto the platform and to register as an investor, and you'll get early access to the new deals that come onto the platform, which we expect to be early next year.
Yeah, and please reach out to myself or to the team here if you'd like to discuss any of these in more detail. I got a question which I'm going to answer myself here. Will these investments be marketed as securities, and will the SEC require listing them on an exchange or OTC? Yes, absolutely, they'll be marketed as securities. The fund that we're raising for now is a Reg D private placement, but the fractionalized, tokenized securities on our marketplace will be offered via Reg A in 2023, and they'll be trading on Texture's ATS again in 2023. Another question coming in here, curious how you came to select Algorand as the underlying protocol for the assets.
Yeah, I mean, we get that question a lot, really, and there's a couple of very simple answers. First of all, the technology itself has to be fit for purpose. So the way that Algorand have structured one of their protocols, which is known as the ASA or Algorand Standard Asset, built into the asset itself, built into the protocol, are all the things that we need to issue securities on the blockchain. That means that we don't have to build our own smart contracts and wrap those around an existing protocol. And that makes it much more reliable, and it makes it much less, much harder for security breaches. So in other words, first of all, the actual underlying asset itself, the underlying blockchain itself, is purpose-built for securities. Secondly, Algorand is here to stay. So there are a number of protocols where we're simply not convinced that they have the ability to sort of be here for long enough. And we believe, based on our research, that the amount of the size of the Algorand ecosystem and the size of the number of people that use Algorand means that the technology is here to stay, and is robust enough to deliver what we need, at the cost that we need. So the cost per transaction is sort of statistically insignificant almost, and that's a very important part as well.
Mm-hmm. And I'll just re-emphasize that whilst Algorand has their own token, which is a crypto token, everything we've talked about today in this webinar will be securities that will be offered in full compliance with securities regulations.
And again, just it's important to stress that the Algorand protocol and the blockchain is used to keep a record of the transactions after they've happened. So all of the heavy lifting that needs to happen before that is done off-chain, using technology that is tried and tested, that we're in control of. It's only after that transaction has happened that we then hand it over to the blockchain and then effectively print it onto the blockchain, onto the Algorand network. So we're not building our business on something that cannot very simply be unscrewed and replaced by another blockchain technology or another protocol if we end up encountering problems with Algorand.
Good point. So let's wrap this up. What are the key takeaways here?
Going back to the initial slide, are we solving a problem? And the answer is yes. Fundamentally, we are solving significant, large, scalable problems for enormous numbers of people in the US. So this is not a technology in search of an application. We're solving a problem that affects many, many people. And it's a very important problem to solve. And we're doing it in a way that is scalable using technologies that really were built for this type of application. So again, what we're not doing is working with blockchain in search of an application. This is an ideal solution, an ideal blockchain-based application. And the business model itself generates significant cash flow for us. When we originate transactions, we get paid. When deals move onto the platform, when we get paid. When trading happens on the platform, there is an opportunity for us to generate revenues. And there are significant numbers of other types of revenues that we can tap into because we're at the epicenter of homeowners, investors, and trading. And last, and certainly not least, it's built and we're ready to scale.
Great. Thank you very much, everyone. And thank you, participants, for your time. If anyone has any questions, please reach out to me, Richard at Texture.Capital. I'm sure you have my email address. And I look forward to hearing from you. Thank you.
Thank you very much.
Thank you.
Thank you.
The foregoing discussion is for information purposes only and does not constitute a solicitation to buy or sell securities. Private securities offerings are not registered with the SEC and are considered highly speculative. An investment in private securities may result in the loss of your entire capital contribution. Blockchain is a new technology and unproven in financial markets. There is no guarantee that tokenization will enable any secondary market liquidity in the future, and your investment may remain illiquid.